within this huge down move and the bounce back up, there's been back and forth trade. But how do you manage if you're long in your investments, whether that be long the dollar or long yields with small 10-year yields or 30-year yields or 2-year yields? How do you trade? Can you even manage to trade on a more active day trading basis or, swing trading couple of day basis if you're investing? So this is kind of, I think, the next iteration. I'd love to hear what you think. Is it too complex for the average person to manage a core position and then, for, quote unquote, for a lack of a better phrase, take apart part of it, at least synthetically, for trade opportunity?
Yeah, I mean, you're right. This is a perfect segment for today, given where we are, because we've had some interesting movements in the market, as you kind of alluded to. Like, we've had some things move around a good bit. I mean, we just saw, yields drop the other day, and then they were dropping again this morning.
I know.
I mean, they create some great opportunities. And in my mind, like this says, investing is simply buying or selling with the intention of long-term profits. I think most people, think about that. I think this is good that we have this up here, because in the last year or so, I think there's been a lot more trading than investing, to be totally honest. And, for good reason. I mean, look where we came from. I mean, a year ago this time, right, we were, and look where we are now. And at every step along the way, you couldn't tell most people that we're probably going to have a big backtrack because of, what we were coming out of and what's going on and the uncertainty, in the world right now. I mean, there's still some more uncertainty, right? There's still, talk about it right now. So I would say most of the time, as I've started to get used to trading futures, I would say a lot of it, I'd say, like in the beginning, like when I was trading the dollar, I think that was my first trade. And I was looking at that more of a longer term horizon initially. And it just so happened, I think we had a Fed meeting that created an opportunity for me to sort of, lose that position for the time being, meaning get out, lose, trading terms. We all, what I'm talking about.
Absolutely.
Lose it.
This is what we do. We manage mechanically. That's what keeps us alive.
Yeah. And so I think for the most part, like right now I'm back in the 10-year, I'm looking at it as a trading opportunity, but do you look at many, future situations as like long-term investing or no? I mean, what do you think?
Boy, you know what? Depends on the product. Core position. Like I think 2-year yields at, 17 basis points right now. Now I'm long above 20 basis points, but at 17 basis points, a 2-year yield is actually, no matter how you look at inflation, tips, CPI, PPI, whatever, there's a huge amount of negative yield to that. And what I mean by that is there's real rates and nominal rates. Nominal rates are what we see, the 17 basis points. The real rate is the nominal rate minus the inflation rate. So if you say there's 2% inflation out there, and who knows what it really is.
So I was going to ask you.
Right, that's saying for the next 2 years, I'm losing almost 1.8% on my money, which doesn't seem to make any sense whatsoever. So does that mean the 2-year yields are cheap or there's a better investment? And maybe that's part of the reason why we see these relenting rallies in the equities markets. But so I've got a core position of long 2 years. I don't think the Fed has any intention of wanting anything to trade below zero. They're holding the Fed funds rate, which keeps flirting with zero because of this flush of liquidity in the overnight markets, and they're intervening to keep that rate above zero because there's so much money being attempted to be placed in the overnight markets. It's not something we trade, so I really shouldn't necessarily. It's just confusing, but it speaks to the idea of I don't think the Fed wants anything below zero. And 17 basis points, where's the risk? And sir, we can go down to 10 basis points or 5, but I think long-term, I like this as a core position. So I look at this as part of, I've got in my portfolio of, like my investment portfolio and my retirement portfolio, long stocks.
Yeah.
This is another kind of long position that I have and want to maintain. And it may take 6 months, it may take 9 months. I want to hold on to this. So investing is part of this. Now, and we looked at a trade where 30-year and 2-year yields are very close to one another.
Mhm.
That would involve buying 30-year futures, S30Y, and selling your S2Y. So if I'm taking a short-term view on what they call yield curve compression, or the TUB spread, 2 years versus 30 years, and buying that, I'm taking a part of my long-term 2-year position because I have to sell part of that out to do that spread. So I think there is the ability, but I've got to remember that part of that lighter 2-year long core position is because I've got the scalp on. So I've got to separate those two trades. So it's a little bit more, I would say, bookkeeping, record keeping. But yes, I think there is the ability to do both. So if we could jump one ahead.
Yeah, no, ladies. Yeah, no, this is good. We're going ahead. But ladies and gentlemen, this is why I love talking to Pete, because you said TUB spread. I've actually never heard that. So that's what they call, that's a short way to say 2-year, 30-year spread.
Right. And another way you might hear it referred to as the barbells. It's the shortest duration Treasury note and the longest duration Treasury bond that the Treasury sells.
Yeah.
So traditionally, a very volatile spread. Recently, with all yields, kind of a compressed, slower moving spread. We're in an environment where we see 30s and 10s move about the same amount every day, which is not a normal environment.
Okay. That's
right now, enough. 30s are down three ticks, 10 years are down 5 ticks. We never really have seen it. So it speaks to this compression in yields. But yeah, so that's one spread. So and
is that probably based off of a little bit that people are worried about, or a little bit of return to lockdowns, a little bit of return to travel restrictions and things like that?
It sure seems like that. It seems there is such a tremendous amount of complacency that yields are not going anywhere. And the Fed is going to continue to buy 120 billion a month of all these, some treasuries, some mortgage-backed securities, or what they call MBSs. And yields aren't going to materially change. And we're going to live with this yield market that actually generates, if you buy a 10-year note now, at 1.17%, and inflation is at 2%. If you think about that, you're losing money every year. You're getting coupons that are giving you around 1% of return, and the general purchasing power of that dollar is losing 2% per year. So net, you're losing 1% on your money. Does that make treasuries less interesting? I think it's got to be one of the reasons. But at what point does that normalize? And so there's trading opportunity in these treasuries. So how, we could go into different treasury products. Trading is the same with short-term intentions. So we're combining investing and trading as two different but the same type of idea. So we're kind of normalizing this short-term opportunity, which I think, and I'm curious to hear your thoughts on, in the long term, I find that the mix of a long-term strategy combined with short-term trading opportunities actually smooths out my P&L. And hopefully it smooths it out as upward, but it takes this away from it.
I totally agree. Like you said, I mean, there's, within the portfolio, I have these long-term positions like, AT&T dividend stock. I got, PPL, which is a utilities dividend stock. And that sort of helps out, smooth out I have that all set up, in that portfolio with the idea of trading 10-year futures, US small 10-year futures, but also every now and again, a couple of option positions. And I flip the portfolio so that I can see where I'm collecting, where I'm paying, and the idea of paying for those long stocks and collecting on, whether it's the short-term vol that I'm collecting here and there. And then I also have those margin positions like the US 10-year and also now the US 30-year. And it does smooth out the portfolio, like it smooths out P&L over time. Like I pretty much know for the most part, if it's a big day where it's most of it's down, it's one like I think might have been earlier in the day today. It's like, okay, where everything is kind of down, this is what's going on, overall. And you can kind of get an idea pretty quickly about what you're losing money on, what you're making money on. And so it does smooth things out. All the trades are different. They're not the same. And those longer term trades, I'm not as worried about those, like, it's like, okay, those are longer term, those are, and I also have like still have this Apple poor man's covered call on. So that's like a longer term trade too. It's like I'm not looking at that as much every day. The P&L is going to swing, which is a little more annoying in that, but I'm not as worried about it. You know, like I do pay attention more to those that were what gets my attention day to day more is these trading opportunities, like currently what we have in U.S. 10-year.
Right. And I think you hit on it perfectly in terms of the overlap of the diversification. So not only are you mixing your trading strategies in terms of time frame, you're using different products. Both those are smoothers of P&L. So if we can jump one ahead.
And then separate from that, I actually have a portfolio where I do a lot more trading, if you will. And that P&L does fluctuate a little more, right? Like, because those are more short-term opportunities. Those are more trading situations, you know, and so it helps me out to do that. And, you know, that's something that I know I learned a while ago, but I would say more people should do that if you have the ability to, even if it's a small amount of money, having a different account, you know, so that you don't look at it as much.
And you know what? It's whatever it takes, whether it's a different account or writing it down to keep to keep clarity around if you have something against the core position that you had lightened it up because you have another pairs trade against it. Take some notes. I told this story before, but when I was in the pit, there was a guy who had a little notebook and he'd jot down things in the notebook. And we used to just abuse this guy for he turned out to be one of the most successful traders I've ever seen. And whatever combination of things, but you know what, he found the tools he needed to be very, very successful. So whatever it takes, and whether it's a different account so you can keep ideas separated or notes to keep them separated. But the question becomes here, and and this is a great question, Jermal, what do you think here? What do you do when this short-term and long-term investing and trading ideas overlap?
Yeah, I mean, that's a pretty good question. I'm trying to think of a scenario where that might happen. I guess, there could be times where something, this is what comes to my mind. You could have, let's say you have a situation where something has moved so far, and it's a long-term position, but it has moved so far, so fast, let's say to the upside, and you're thinking, okay, this is a good opportunity to get short just for a little bit. That's probably maybe one situation. It doesn't necessarily define what, has happened in the small 10-year yield, I don't think, but that's where my mind goes, where I see this question. And, in that situation, I'm thinking of options. I'm thinking of something that maybe you have a longer term, let's say a lead position on, and you decide to, sell a call spread against it because it's just moved up so fast, so far in a short time period. That's what I think of. But I'm not, is there a situation for futures?
Well, I think it is this idea of, so in the example of overlap was just going back a bit to got a core position of long 2 years, and I want to trade the tub spread, which means I'm buying 30s and selling 2s. So let's say my core position was long 10 lots of the 2s, and I want to sell some of that out because I'm going to be buying the 30s. So I am going to take, say, half that position off. In my mind, I still have a long 10 lot 2 year position, but I've got a scalp wrapped into it, which is long the 30s, short the 2s. Now, I've got to treat each of those, as you said, differently. I will keep those trades in the same account because the margin of having to have both trades in different accounts is a little bit more expensive to do. But how do you keep those two ideas in check? I've got a long-term strategy and a short-term one. And the key for me to do that is, whether it's taking notes or separating them in some other fashion on the platform or within your P&L, is around idea generation. We talk about we always use tools like statistics, we use probabilities, we use bias, and then we go through mechanics. So we decide on trade entry and exit, what we want to do before we ever put that trade on. So the management piece should be the easiest piece because you've already decided that before you put the trade on. If we can jump one slide ahead, This is the key part. How do we do both, Jermal?
You can trade and invest with trading mechanics. Just use it, but looking at those different time frames, like you said, right? Like, so if you look at the different time frames, you look at a chart across different time frames, you still use those trading mechanics, but you're able to not only trade with short-term stuff, but you're also able to do that with investing on a long-term time frame as well.
Absolutely. So that trading tub spread that I'm long is a short-term trade. I may be looking for 30 or 40 or $50 on it, willing to risk $50. And I am managing that position by itself. I've got a longer term position that I may be I'm giving much more rope. I'm probably out $350, $400 per contract right now where it's trading. I'm giving much more rope because I have a long-term bias to that. This short-term trade is a different trade that I've done mechanically. Both of them are mechanically. If yields get down to 1.15 basis points, I'm going to have to make a decision whether or not I still like being long core 2 years. That's a different part of this discussion. But the idea that you can trade and invest by using mechanics, it's mechanics around time frame. So I've got my short-term tub trade. I've got $50 I'm risking on either side of that. So I'm going to keep that in mind. Otherwise, this becomes just a blended mess, and I don't know what I'm managing or what I have. So the breakout is, I've got a trade idea that's short-term. By definition, it's going to take away some of my long-term core position. That's fine, as long as I keep track of the two positions, and I do that with mechanics around trade ideas. And the short-term trade idea just becomes part of that journey, and I manage it. That's a key part. I don't let everything become a long-term position if it rolls against me. I know I've got a $50 1 or 2 day position here that I'm trading, and I've got a core position sitting there also. So if I manage my short-term position, my long-term core position comes back naturally. But that is an important part of this trading and investing idea. I could do both as long as I employ the proper mechanics. And you walked through it wonderfully in terms of how do I do that and what am I thinking about? Any last thoughts as we walk away from this, Jermal?
No, man. You always do a good job of laying out the different ways of talking about the mechanics. And as a matter of fact, I've recently I created this reminder for myself every morning: stay mechanical with your trading. And I have it in my phone. It pops up every morning at like half hour after the market. I mean, it helps actually. It just helps me. Reminds me of those situations. And so, I think that's always key, staying along with your mechanics, trading mechanically.
I think, that's a perfect way to sum this up is whatever it takes for you to stay mechanical and keep those trades at a comfortable point for yourself, whatever it is, everybody's different, but find what's comfortable for you. Thanks so much, Jermal, for continuing to take us on this journey from the world of options to the world of futures, my friend. It's been terrific, and we'll continue this voyage on Thursday with your good friend, Frank Caberna. So, guys, stay tuned for Splash into Futures. Frank will be back, and we'll be talking about some trade ideas, and you'll see Jermal back with Frank on Thursday. Have a good day. We'll see you back here in just a little bit.